My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate, teach you, put days like today in context. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. You want to understand today's action? Dow surging 147 points, S&P gaining 0.63%, NASDAQ climbing 0.54%, a rapid rebound after yesterday's hideous beatdown. I'm going to make it real simple for you. The market is a spectacular, albeit mercurial fashion show, just like the real thing. The same stocks that would strut down the market runway greeted with oohs and ahs can be pelted by tomatoes just a few weeks later. Stocks that have languished in the bargain bin for months suddenly start selling like hotcakes. When styles change, we call that a rotation on Wall Street. Investors are furiously recalibrating what they're willing to pay for. And just right now, they're happy to pay up for the stocks of solid companies with healthy dividends and ideally big buybacks. You know what? They've lost interest in the stocks of fast-growing companies when it comes to revenues that issue huge gobs of equity to pay people or come up with some bizarre new metrics to explain how they're really doing okay, even though they don't have much in the way of earnings, if any. In other words, the cloud stocks are out. Salesforce.com, ServiceNow, Adobe, Workday, Okta, CrowdStrike, Palo Alto, Zscaler. I could go on and on. These names were all smoking red hot, and now they're struggling. And you have to wonder, I know what you're thinking at home. You're thinking they were hot. Now something's gone wrong. Have the fundamentals deteriorated? Not at all. Aside from a few exceptions, the numbers remain fantastic. They're just not the numbers people want. Last night, Salesforce reported a monster quarter, and the stories about how the guidance for next quarter was weak, I'm calling them misleading. We know Adobe's been putting up terrific results. Sure, Workday and Palo Alto seems to have disappointed a little, but they still got phenomenal growth rates. So why did these stocks get hammered today? Because we got one more story suggesting that we might have a trade deal. Maybe we're getting closer to a trade deal with China than we were 2 days ago, when we first heard the murmurings that an agreement might be hard to reach. Whenever we get positive chatter about the trade talks, traders start betting on a resurgence in the global economy. And when the global economy accelerates, nobody cares about these stocks with a consistently smoking hot high revenue growth. Instead, Wall Street wants cyclical companies that were doing poorly and can post big earnings growth if we get a stronger environment from a trade deal. Last night, we spoke to Michael McGarry. He's the CEO of PPG. He told us many of his businesses were doing pretty well, but what really represents upside is the Chinese auto market, where PPG coatings dominate because of their universally high quality. If we get any kind of trade deal, this company could have a huge up year in 2020. So the stock flies to another all-time high. When you think of Chinese autos, you gravitate to Illinois Toolworks, a manufacturer that rallied nicely today. Hey, they didn't even have they had a couple of tough quarters, frankly. Who cares? Emerson Electric's chock full of China business, so it runs. Deere, oh, here's a good one. Deere just reported an extremely difficult quarter. Hey, no China trade deal, right? At a time when the trade talks looked like they were just done, dead. Now the stock's flying on the renewed hopes of a trade deal. Same with FedEx, stock that was just criticized by an analyst who suggested the other day estimates are too high. But that won't be the case if the trade deal with China improves. Even 3M, which has had its fair share of problems, has enough Chinese exposure to pique the interest of traders. What else works if we're making progress in the trade talks? Well, any kind of rollback in tariffs would be great news for the retailers. Home Depot got a lot of wares made in China, including many product lines from Stanley Black & Decker, so they both rally. The beleaguered Home Depot can rally. Who else wins from a trade deal? The banks. Because any deal is likely to allow our financial institutions to do more business in the People's Republic. Did you see that stock at J.P. Morgan today? Citigroup, Bank of America, even Goldman Sachs. Oh, and if you need confirmation that things might improve, look no further than the price of oil, which finally got some lift. Now, granted, oil is probably climbing because of OPEC supply cuts. But if the price of crude can rally, that means the oil stocks can rally. And the positive pin action from an oil stock that rallies immediately extends to the drillers, and it's conceivable that it might even extend to the beleaguered master limited partnerships. You went crazy? I found myself saying, am I nuts? Union Pacific, the railroad.
All aboard!
Okay, get this. They came out with some grim tidings today. Fourth quarter volumes are going to be down at least 10%. In another market, this stock might have fallen 10%. On that news, no, went higher, much higher. The fashionistas drooled over the $7 billion plus that Union Pacific returned to shareholders in the first 3 quarters of 2019, including 5 dividend boosts in the past 9 quarters. Industrial volumes flat, ag -2, premium products off 14, energy down 20, coal secular decline. Oh, that didn't matter at all to the buyers because expenses are being slashed left and right. Third quarter workforce down 13%, trains running much more efficiently, 2,800 stored locomotives, allowing for a fabulously low operating ratio. And that's the real driver of performance of the rails. You layer on the possibility of a Chinese deal, and this, I got to tell you, Union Pacific is the one that benefits the most. Oh, and of course, the more cyclical tech hardware stocks work, the ones that play in 5G, data centers, autonomous driving, Internet of Things, that's IoT, electric vehicles, and artificial intelligence. All soared thanks to a terrific pre-announcement by a little outfit called Microchip. They're undervalued by traditional metrics and trade on earnings, not sales, earnings. And those earnings could rocket higher on a trade. So what do you be thinking about? Yes, it's the green light to Micron. It's the green light to Qualcomm. Yes, you can buy Broadcom. Yes, you can do analog devices. Texas Instruments up a little too much. That's what's working as long as the rotation lasts. So what do we do with the stocks that have been kicked off the runway? As I told you earlier this week, the sell-off in the high-flying growth stocks tend to last for a week or even weeks, sometimes longer. Do we really need the stock of Amazon when we can own the much less expensive dividend and buyback king like Apple? What's the appeal of Salesforce.com here after the big Dreamforce confab is over? Alphabet stock rallied, but that's an anomaly based on a management shift, with investors maybe breathing a sigh of relief as the founders step down as co-CEOs with the much more focused Sundar Pichai. Sundar Pichai taking the helm is good news for that stock. There's one big problem with these trade-related rotations, though. They're all as temporary as they are torturous. If the Chinese don't buy billions of dollars in pork, will the slow ones now later be fast because the times they are changing? If the president says he's not rolling back tariffs, if the December 15 tariff hikes go into effect, you'll want the stocks that were being sold today, not the ones that were being bought. That's why I recommend using these rotations to readjust your portfolio. The companies being thrown away are those that are surfing the biggest secular growth story of our era, the digitization of enterprises. They digitize or die, and only about 15% of the world's enterprises have adopted the core digitization of the cloud. That's why I say wait a couple more days, then start doing some buying in the out-of-fashion stocks, anticipating the next wave up. These fashion rotations, well, let me give you the bottom line. They don't turn in a day. So wait a little longer, and then pick your favorite digitization play from the ones I just talked about. It's better to catch them on the way down, not chase them on the way up. Let them come to you. Fortunately, that's exactly what they're doing. Cody in Michigan. Cody.
Hey, Jim, first-time caller, newer investor. Can I get a booyah?
Booyah.
Thank you.
Welcome.
So I got into L Brands near the 52-week low of 1580 on November 20th. I got out a week later after 18% run-up, and a week later gave up 11%, but today it jumped about 8%, closing at 1870. Right. Should I get back in, given the whole rebranding and the Victoria's Secret structure, or what should I do?
Well, you see, I got to tell you, Cody, I am addicted to high quality, and that one is not high quality. So if this starts going back down, I don't have a reason why to recommend it. I mean, take a stock like Five Below, which I like. I mean, the stock was getting hit. Matthew Boss the other day from JP Morgan saying, you know what, it's good. Then they report a great quarter tonight, and the stock is soaring. I'd rather have high quality that's down than a low quality that's really down, hoping for a bounce. And that's what you're playing with. That's called playing with fire. I need Aniketh in Texas. Aniketh.
Hey, Jim. I'm a high school senior, and I wanted your opinion on ARWR, Arrowhead Pharmaceuticals.
You know, this one, they just did an equity offering. Remember, we liked it. It went up 60%. They did an equity offering. Now the stock is trying to settle because they've done a lot of supply out there. You got to wait 4 or 5 days before we see this stock settle because there's stock all over the place. They flooded the joint with merchandise. We can't buy in until we see it settle. I need to go to Tom in Illinois. Tom.
Hey, Jim, thanks for taking my call.
You're welcome.
Yeah, Jim, I've noticed that Luckin Coffee has been going up for the last couple of weeks.
Right.
on a daily basis, and I was wondering if you consider this a buy at this point, and how do you think this will affect Starbucks in China?
Well, I think that they're on parallel tracks. I mean, this stock turned out to be undervalued because it's growing so fast. We talked about with the Nigerians just today when I was on Scott Wapner's show. I think the stock has advanced too much, started selling off today. I prefer Starbucks. Why? Because I like the bluer chip names. And I also, have an aversion to buying Chinese stocks because of the temper of the times. All right, people, listen to me. Use this rotation to readjust your portfolio. Wait a couple more days, then catch your favorite on the way down. That's how we use rotations. We don't chase up. We let it come to us. Mad Money tonight. The truth will set you free, and it can help your portfolio. I'm telling you why. Then I'm talking with Robinhood, men in stocks. I last spoke to the company in 2016, and here's what they said.
We announced a few weeks ago that we just crossed 1 million users.
Today, that number tops 10 million. Congratulations. I've got the exclusive fresh off the announcement. And 21 days until Christmas. Wow, that's all? How is the maker of one of the #1 toys this holiday season positioning itself? I'm talking to the, owner of the Barbie franchise to find out. Do not miss my exclusive with Mattel. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.